everyone, it's Roy Güllüoğlu. Welcome back to the market update featuring by Rationale and MarketsAll. And this week is packed with action. We'll start with the latest non-farm payroll numbers and what they're signaling about the US economy. Then we'll dive into oil price surge, which is creating volatility in the financial markets. Earnings season is also kicking off, starting with banks this week. And lastly, we'll take a closer look at the sharp rise in UK gilt yields, their impact on British pound, and what it means for financial markets at large. So as you can see, there's a lot to unpack. So let's quickly dive in. First of all, here you see the economic calendar of last week. Last week, you might remember that I highlighted the uncertainty surrounding Trump's potential impact on the markets. Now the narrative is evolving with questions about strengthening US labor market with robust non-farm payroll number. You know, this Trump issue was the first thing that creates uncertainty. Now the NFP data from Friday adds to this uncertainty, pushing Fed expectations towards more hawkish stance. The first rate cut in 2025 is now fully priced for December. So the non-farm payroll numbers, the actual number came in 256K. The forecast was 164, and the previous one is 227K. And this number is revised from 212K. So the unemployment rate declined a bit. Average hourly earnings is like at least showing some improvement in the inflation side, not signaling at least any wage price spiral. But yeah, you can see that the wage cooling, but however, wage growth cooling slightly, both in year over year and month over month data. Still, it may temper inflation concerns. This week on Wednesday, we're going to receive the CPI report, and that will be the key data for this week. This mix complicates the Fed's outlook for now, as it suggests a labor market that's strong but not overheating. So that means there is no rush to cut rates, as there's no like a bad signal coming from labor market. At the same time, like the last quarter of 2024, we saw some increase in the inflation that was concerning, and that suggests for Fed that higher for longer. But I still think that we're still in the downtrend. The base scenario has not changed yet. The US indices after NFP number sold off sharply, and while bond yields also surged. This the big question here is this hawkish shift here to stay or not. It depends on, first of all, what will be decisive on this. First of all, Trump's actions in his first few days will be important, because we still don't know among from his agenda, from Republican agenda, which headline will come first, like the immigration policies or tax cuts, or we still don't know. It's uncertain, and each of them has different impact. So that will be the first decisive point. And the second one is CPI trend will be crucial. We need to watch carefully, and we're going to receive the December data on Wednesday 15th. Yeah, let's continue. The other hot topic of this this week is oil prices are off to a strong start this January, with both a Brent and WTI over 8%. This comes after a slow end to 2024, as colder than usual winter has boosted demand for oil, and this also with that demand, we saw that inventories, US crude inventories, have dropped to an 11-year low, and tightening the market and pushing near-term prices higher than future ones. This creates a favorable market structure called backwardation, when the nearer term of future prices are lower than the further ones, I mean, that's called backwardation, where investors can profit from rolling yields. Rolling, I mean, when you buy a future, then when the like deadline comes, sell and the roll to the new one. That means like roll yields. Essentially, when they roll over expiring futures contracts into cheaper ones for like a later delivery, they can lock in some positive returns. Currently offering annualized yield around like 15%. This has become a big incentive for investors, and they stay bullish on oil right now. And adding to the momentum on like a fresh US sanctions on Russian oil, it has moved, I think, like a 1.5 million barrel per day. While these sanctions are mostly factored into prices, they have kept supply risk in focus. Speculators have also jumped in, and so the long positions are increasing right now for both Brent and gas oil. Now like a VTI is pushing, like going around like $80. There is like a room maybe until like $85, as you can see in the chart, $85, maybe 90. But in 2025, it is expected that the overall oil supply will be higher than the oil demand. So I think like if you're follower of these videos, I've been showing a symmetrical triangle chart pattern in the oil that I was expecting it to act. It didn't manage to go. It didn't manage to go down with the geopolitical concerns and stuff. And I'll show it at the graphs chart section of this video as well. But yeah, I still don't believe that the bullish scenario will stay there for a long time. I mean, this is an impact of this like short term, like a winter impact, and also like sanctions. Combining all of them, it created a huge demand for short term oil, which caused a backwardation. With backwardation, there's a rolling yield occurred, and speculators are like benefiting out of it. That's the way to summarize this. But the big picture is still, I wouldn't be like that, like a powerfully bullish on oil. So another hot topic: earnings season kicks off this week with banks reporting Q4 results. S&P 500 is forecast to post like 11.7% year-over-year growth, as you can see here. This like a gray bar is the expectation for Q4 2024, and historically most companies exceeded estimates. The FactSet research expect actual. By the way, so maybe I missed. Source FactSet. This chart, this table. So historically, like the FactSet research expect actual growth to surpass like 14%. We need to watch like a key sectors right now, which have drove S&P 500 until these levels, which are like a financial, technology, and consumer discretionary sectors, for guidance on broader market sentiment. And the financial sector will be in the spotlight this week as bank earnings season kicks off on Wednesday, January 15th. While like there will be a mix of positive, like higher net interest margin and growth in loans and deposits, and negatives like lower non-interest income and maybe the impact of higher long-term rates that we're experiencing right now. The main focus will be on updated guidance from earnings calls, according to FactSet. So based on late Q4 commentary, a steeper yield curve also, and expectation for more relaxed regulatory environment, the outlook is still positive. Steeper yield curve means like when the short end of the yield curve is lower than the high, which is like a normal yield curve. And in such scenario, as you might all know, that banks generally lends in long end and like get deposits in like their liabilities in short term. When it's like the long end is higher than the other one, it's an opportunity for them to make money. Yeah, that's the situation about earnings, and next video will be evaluating the results. And the next topic, I'm switching quickly here. In this chart you see pound USD chart, the last, like, I don't know, last 1 2 3 4 5 last 5 days, 3.7% depreciation, which is really high for an currency. UK bond yields, or like it's called gilts, have been hit by a major sell-off in recent months. That's the reason that you see in this chart. The 10-year yield has climbed 24 basis points since the start of the year and nearly 100 basis points since last September, reaching its highest level since 2008. This sharp rise in yields, partly driven by global market trends, it's creating big like challenges for UK economy, because like they're also doing export and import with US, the sanction potentially, US yields going up, and all like a general like situation. The economic growth is struggling all around the world. It's putting pressure on like a growth and government finances and Bank of England's ability to adjust its monetary policy. The surge in yields come from like a mix of global of UK specific issues, weak public finances, which is like an ongoing budget deficits, and limited flexibility are increasing the risk premium on UK bonds. I mean, the investors are asking more yields to stay at like on bonds with amid ongoing budget deficits. Second one, slow economic growth. The UK is underperforming compared to other major economies. The third one is cautious central bank. There's a persistent inflation has kept the Bank of England from easing policy aggressively, and increasing bond supply is another issue. The government is issuing more bonds, adding extra pressure on yields in order to finance expenditure. So how this affects the markets? Rising bond yields are tightening for sure financial conditions, which has impacts on, first of all, economic growth. Like higher yields make mortgages and business loans more expensive and weighing on household spending and business investments. Estimates suggest like that could shave around like a 0.1% of GDP over the next 2 years with this high yields. Second impact on stocks. Higher borrowing costs hurt companies, especially those reliant on debt. As a result, like UK equities are like there's a heat with sectors like real estate and the utilities underperforming. But generally, like when you check the FTSE 100 index, the main companies here, like they're paying dividend in USD. They're like doing business with all over the world. They're not like a UK specific. That's why you don't see that much harm. Like, I mean, yeah, there's a decline, but yeah, it's not. I mean, there are some other companies that are highly impacted from the situation compared to those. And GBP currency, there's another impact on GBP currency, as you can see in this chart. While the GBP might get some support from higher yield, it's like a overall performance is mixed. Like that's not like this situation specific. With higher inflation expectation and higher like relatively hawkish Bank of England, pound was performing relatively well, by the way. With this like a gilt price, let's call it's like that, we saw this depreciation. But yeah, this economic uncertainty for sure caused to sell off. So what's next? The Bank of England is stuck a bit, and they're gonna lower interest rates. But inflation is still a big concern, limiting how much they can decline like cut rates. Meanwhile, like government faces tough fiscal decisions, rising borrowing costs, add like a lot of costs to public debt over the next few years, which may force for more spending cuts or tax hikes. Maybe you can remember from our previous videos, one of them, I don't remember which was done, but they were also doing some they were cutting some costs, like fiscal costs, in order to finance this public debt situation. So yeah, for the markets, this means continued volatility for sure. Stocks will remain sensitive to changes in growth forecasts and monetary policy for sure. The pound could stay under pressure if the economy does not show any clear signs of improvement. Also, inflation will be another key thing that we need to watch. So let me quickly switch to chart section. First of all, this week I would like to start with gold chart. As you can see here in the weekly, let's start with weekly. After this huge breakout, let me not remind this. Let's focus this one quickly. In the daily chart, there's a symmetrical triangle chart pattern. Generally, symmetrical triangle chart patterns are prone to go to both directions. But here, it's the price is above all moving averages. And considering all geopolitical issues, sanctions on US, and general yields all around the world, starting with US, are going to be cut. They're gonna cut rates. I mean, with that scenario, that's the base scenario still. With that being the base scenario, putting geopolitical risks, combining these two, bullish scenario, and after this, look at this one. In the monthly chart, there's a huge $10, or you can consider just this part as a head and shoulder continuation. Doesn't matter, but in the monthly chart, it's a huge breakout. Technically, without even thinking the narrative, what might drive this price go up or something, just even with this technically, after this kind of huge trend, we generally expect some pullback around a long-term moving averages, 40-week moving average. Here you can see this red line. In the daily one also, this red line is 200-day moving average. If this consolidation persists, we will see that this moving averages will converge here around, and those moving averages might act as support. But after Trump came in with rising yields, for sure, the gold is expected to come down, and this price movement is the result of that situation. But as you can see, the resistance is really strong. It didn't go below this level, below I don't know 2500 levels, and it's consolidating around here. And technically, it makes sense. I don't know, if I see a breakout, this might be a good opportunity. The other chart is crude oil. This was in the weekly chart. This was the symmetrical triangle that I was mentioning while I was talking about crude oil. This breakdown didn't act, and it didn't work, and I don't see any clear chart pattern for now. But this was unexpected for me, to be honest. And with those sanctions are also not that it was an outlier situation. You never guess about the news. Just the news comes in, all pricing's changing. You don't have control on it. You just have control on your portfolio, and you can only do with proper risk management, having a stop loss around here. I would be stopped out if I weren't. That's the only thing that you have control on it. And yeah, that's the current situation. If I see any apart from the news that I talked, if I see any a clear chart pattern, I'll be sharing through a Twitter. You can follow me through Twitter, or you can just subscribe to Rationale newsletter. I'll be posting. Yeah, you can also follow me from there. And euro dollar, this was one of the famous chart that I was mentioning in last month, during the last month, or in all videos maybe. Breakdown occur, we might see a pullback, but yeah, it's still, there's an intact, this downtrend is still intact. So one touch, two touch, three touch, four touch, a little bit up, then come down, breakdown, powerful one. I mean, so in general, the DXY bullishness might be limited at some point with rates coming down. But when I consider this, when I think of if this mentality is valid against euro, I have some dots though. I have some dots, because euro has a lot of issue with, first of all, economic growth. That's why there'll be more they'll be the most dovish central bank, especially compared to US. And also Russian sanctions, they're not providing gas and stuff, and that's another issue. That's another pressure on European economy. So with those in mind, I don't see any strength coming from euro side. That's why despite the fact that USD's bullishness is limited, maybe at some point, because the rate's gonna come down, and we might expect to see some positive impact on economic growth with Trump expectations and stuff. When it comes against euro, I'll be cautious. I'll be definitely, if I want to be bearish in USD at some point, maybe I'll go to maybe AUUSD, as it's because OC is more related to growth scenarios in general in world, and that might be a turmoil or something. But euro is not in my mind for now. Also technically, here you see it's obvious. And another chart that I just wanted to show you, franc yen chart. Yen is the most I mean, at some point we'll be seeing that yen is gonna appreciate because of they're gonna rise rates, and franc is known that it's highly correlated with gold in general. And as you can see, this chart is pretty similar with the gold chart, and I'll be watching if I see a breakdown. As I mentioned, this symmetrical triangle chart patterns are both directional, it might go to both direction. Maybe if this comes down, that means yen is appreciating against franc. That means the expectation of Bank of Japan hiking rates is getting firmer, getting stronger. So yeah, that's how I will be watching this chart. And still, now currently it's just below all short-term and long-term moving averages. That's why I'll be watching this breakdown to see if there's an opportunity to trade. And this is the way, this head and shoulder top chart pattern is the way that I'm watching Bitcoin. So if this breaks out from here, then head and shoulder failure chart pattern will be in action. If this breakdown from here, head and shoulder top chart pattern will be in action, and I will act accordingly. As I mentioned before, I don't do any guess about the direction. I just generally, I have a narrative about any kind of instrument, if it's risk on or risk off, depends on that. And after that, I let technical chart patterns to direct me in any way, and then I apply my proper risk management methods. And another one, Ethereum chart. In the weekly chart, here you can see if we see a reaction from here, I don't know, turning, if we see a turning from here, that's gonna lead to form a head and shoulder continuation chart pattern. That's how I'm watching. And when I come to daily chart, if I see a consolidation, maybe I can try an early entry to catch this action from here to here, up until this neckline, just before the breakout. And yeah, so that's all I'm gonna talk about this week. Thank you for your time. Thanks for watching. And if you have any question, as usual, please comment below the video. And if you wanna get all these these kind of trade ideas directly to your inbox, you can subscribe for free to Rationale newsletter service from the link below the video. And also you can become a member in MarketsAll, like a MarketsAll brokerage firm, and you can visit the website. The link is also below the video. And that's all I'm going to talk about this week. And we're going to receive inflation report on Wednesday. That will be decisive on market pricing. I wish you good luck and have a great week. Bye.